Guys, look around. Can you smell the fear? The market is bleeding, and Bitcoin is crashed below $39,000. Ethereum's struggling to hold 3,000, and the Fear and Greed Index is signaling extreme fear. We're at levels of 14, 15, numbers we haven't seen since the darkest days of 2022, the days of the Terra Luna collapse and the FTX bankruptcy, as we all know. The verdict on social media and among analysts seems unanimous. The high on October 6th, $126,000, was the top. The party's over. The 4-year cycle, has struck again. Prepare for the crypto winter. But is it really that simple? What if I told you we're collectively ignoring 30 historical signals to focus only on the ones that confirm our fears? Today, I want to take a step back from the panic and analyze the situation with a clear head. Because what we're experiencing might not be the start of a bear market, but one of the biggest and most sophisticated traps in the history of Bitcoin. Welcome. First of all, I don't want to downplay the situation. The negative signals are there and they're powerful. Let's analyze the chaos, the case for the bears. First, the technical analysis is a disaster, really. We've lost the psychological support of $60,000, but that's not all. The infamous death cross has appeared on the daily chart. The 50-day moving average has crossed below the 200. Historically, a signal of a long-term trend reversal. And then there's another finishing blow, right? The weekly close below the 50-week moving average. For many traders, this is the impossible line between the bulls and the bears. In 2021, its break marked the beginning of the end. Second, the disappointment. Let's look at Bitcoin's annual performance, plus 5% annually. In a year when we were expecting fireworks, the Nasdaq has done better. This disappoints the speculative investors, the ones who are here for the explosive returns, not for the technology. The third is the immediate culprit, right? The ETFs. Last week was brutal. On November 14th, $463 million flowed out of BlackRock alone. It was these outflows that triggered the crash below $60,000. So we have terrible technical signals, disappointing performance, and institutional demand pulling back. Seems like a close case, right? Wrong. The problem with this narrative, in my opinion, is that it's based on a selective view of history. Technical analysis isn't a law of physics. It's the graphical representation of human emotion. And in a retail-dominated market, which Bitcoin was until yesterday, they become a self-fulfilling prophecy, right? If everyone believes that a broken line means a crash, everyone sells, and then the crash is bound to happen. But if we want to use history as a guide, then let's use all of it. This is where the 30... I want to show you the 30 peak indicators from CoinGlass, right? What am I talking about? They're mathematical, on-chain, and technical tools that have been backtested on Bitcoin's history. Indicators that in the past have predicted market peaks with frightening accuracy. Often 100%, guys. Let's look at a few of the most important ones. The Pi cycle tap. It's the sniper cycles. It uses two specific moving averages, the 111 and the 350-day. And when they cross, it historically identifies the top within 3 days. The last time it fired? April 2021. Since then, absolute silence. Today, the lines are very far apart. The MVRV Z-score. This one is fundamental. It measures if Bitcoin is expensive or cheap by comparing its market value with its on-chain realized value. The average price at which coins were moved, weighted by volatility, of course. To signal an imminent peak, it has to surpass a value of 5. You know where it is today? Around 2. During the October peak, it was barely at 2.29. And then there's the Puell multiple. It analyzes miner revenue. In the past, it was crucial, but today it tells us a different story. It didn't signal the 2021 top, nor the current one. Why? Because the impact of miners diminishes with every halving. And this indicator is losing relevance. Maybe even the rigid 4-year theory based on the halving is starting to show cracks. I could go on with the Bitcoin bubble index, the reserve risk, or the RHODL ratio, but the result is staggering in its clarity. 0 out of 30, guys. 0 out of 30. None of these historical indicators confirm that the peak has been reached. So then, why are we terrified of the 50-week moving average? While we ignore 30 tools that tell us the opposite? Maybe it's the major macroeconomic shift? The answer is that we're in uncharted territory. The phrase, "this time is different," is the most dangerous in finance. But the truth is that the market structure is objectively different. Let's start with the institutional wall, the ETFs. We're no longer in a retail-only market. The arrival of the ETFs has changed the rules of the game. They drove the growth in 2024. It's true, capital is flowing out now, and that hurts. But the infrastructure is here to stay, believe me. Do you really believe that BlackRock, Fidelity, and the others launch these products just to abandon them in the next 3 years of a bear market? When the macro sentiment changes, these channels will transform a trickle of demand into a flood. Let's move on to the buyers of last resort, the DATs, the so-called DATs. In past cycles, when retail capitulated, there was no one left to buy. Today, we have Michael Saylor's digital asset treasury strategy, Bitmain, Tom Lee. These entities don't look at technical analysis. They're not worried about the 4-year cycle. They have a long-term vision and buy constantly. MicroStrategy was buying all last week despite the crash. They represent a fundamental support that simply didn't exist before. Let's move on to global liquidity and the real powder keg of stablecoins. We can't ignore the global macro context. There's uncertainty. There is. The probability of an interest rate cut by the Fed in December is decreasing. It's now around 43%, according to the CME. This is a real risk. High rates mean less liquidity for risky assets like Bitcoin. However, let's look at the sector's internal liquidity. There's a powder keg ready to explode, stablecoins. Currently, there are $104 billion parked in Tether, USDC, and other stablecoins. This enormous mass of capital hasn't yet poured into the market. It's the high-octane fuel waiting for a spark, in my opinion. The conclusion. Who controls the market? Let's sum it up. On one hand, we have extreme fear, justified by technical signals that worked in the past in a retail-driven market and in an uncertain macro context. On the other hand, we have 30 historical indicators that deny we've reached the peak, quantitative projections like the Bitcoin terminal price that indicate targets of $175,000 and $230,000. And an unprecedented structural force, thanks to ETFs and DATs. We're living in a fear similar to that of 2022, guys, but without the fundamental failures. There's no FTX collapsing. There are institutionals taking profits and market manipulations that try to trigger cascade liquidations, as suggested by Tom Lee. The crucial question you have to answer isn't about the 50-week moving average, guys. The question is, who really controls this market today? Who really controls this market today? Is it still the retail investor who looks at the past with fear and reacts emotionally to historical patterns? Or is it the new institutional players who look at the long-term fundamentals, accumulate during weakness, and patiently wait for global liquidity to start flowing again? History repeats itself, they say, guys, but sometimes the rules of the game change, okay? Well, what we've done today is the way I approach market analysis. I try to objectively look at all the factors on the table. Technical analysis is fundamental, but it's not everything. The global macroeconomic context and the on-chain data. The goal is to remain rational, beyond the fear and euphoria of the moment, and not let your convictions be stolen by the background noise. I hope you like this approach, that it's useful to you. And if you'd like me to provide this type of in-depth analysis once a week, let me know. Leave a like on this video if you enjoyed it, and write it in the comments. Thanks for watching, and see you next time. Bye. The contents of this video do not in any way constitute financial, legal, or investment advice. The opinions expressed, including those presented through the character Andrea AI, are interpretations of the book's themes and should not be used to make financial decisions. The cryptocurrency market is highly volatile. Always do your own research.